How do you really know what your financial advisor is actually charging you for their services? What are the different kinds of fees that you see on your statement? And what about those fees that you don't see on your statement, but that you know you're paying for? Hi, everybody. Welcome to the next installment in our What Your Advisor Isn't Telling You video series. My name is Greg Parker with Engrave Wealth, and we wanted to work through a very quick video talking about fees. What types of investment expenses are you likely to incur based on the different types of work that a financial advisor might do for you? The tricky part about fees and expenses is that there are going to be some of those fees that are out of pocket and somewhat visible. In other words, when you work with a financial advisor and you get statements from that financial advisor, or you can go online and see your account, there are certain fees that you're going to be able to see on a very regular basis. For example, some of those fees are going to be categorized as advisory fees. Now, advisory fees are a relatively new invention in the financial advisor space. Most advisors have left the days of pure commission-only business, and they now work off of some kind of annual fee. Most advisors today use a percentage of assets formula to determine your annual fee. So for example, the average advisor out there might say that we charge 1% a year to help manage your investments and provide financial planning services. You need to be certain, because sometimes basic services might be additional fees. We've seen cases where financial advisors will charge a percentage-based advisory fee on the portfolio, while at the same time assessing some form of quarterly or monthly financial planning fee to do additional fee-based planning. Make sure you know what is included in the advisory fee that you're paying for your advisor. Most advisory fees today that are percentage of assets are calculated on either a monthly or quarterly basis, yet they're quoted as an annual fee. What that simply means is that if your advisor says you are paying 1% per year, you would know that if the advisor assesses fees monthly, they're taking the account values at the end of every month, multiplying by the 1% advisory rate, and then simply dividing it by 12 to get a monthly fee. That fee should always show up on your statement. If you have an advisor that's charging an annual fee that's assessed quarterly or monthly, and you do not see where it is on your statement, that's question number one you need to ask at your next advisory review. Where can I see your fee? How do I know how much it is? And what does it translate to in dollar terms? The second type of fee that you might notice if you're looking at your financial advisor statement or your brokerage statement are going to be some form of transaction fees or commissions. Most of the time, those transaction fees or commissions are assessed by the bank or broker dealer that is holding your investments for you. If you work with an advisor that's with one of the big banks or brokerage firms, those fees might not be obvious when you look at your monthly statements, but you can always get an assessment from your advisor of exactly what you're paying in transaction fees and commissions for trading purposes. That's something that's supposed to be disclosed on a regular basis. Those transaction fees and commissions can vary depending upon which firm you work with. Traditionally, the broker dealers that are known to be supermarket type firms, such as Charles Schwab or Fidelity or Vanguard, historically have the lowest transaction fees or commissions. But even in those cases, you need to be careful, because the transaction fees and commissions can vary depending upon the types of products that you buy. For example, at Charles Schwab, if you are using traditional ETFs, indexed ETFs, or individual stocks, most of those trade with no transaction fees and no commissions. However, if you use a more traditional mutual fund, you may notice a transaction fee for both buying and or selling that could be as much as $75 to $90 per trade. Let those be a guide for you to understand better which products could be best to own and which keep your transaction fees and commissions the lowest. Every firm is different. You'll need to ask your specific brokerage firm which of those transaction fees and commissions apply and which products might be able to avoid them. Finally, there's the very tricky part of fees that you may not see. The unseen expenses are typically related to the types of investments that you own. For example, if you own mutual funds or ETFs, most mutual funds and ETFs have what is known as a management fee. Now, those management fees are not something you're paying directly out of pocket. The way the management fee works on a mutual fund or ETF is it a fee that is simply taken on a monthly or quarterly basis directly from the net assets of the fund. That means it never shows up on your statement. It's never a fee that you are going to see a dollar amount of what you've paid for. It is simply going to reduce the potential return of the investment you've chosen. So for example, if a given mutual fund has an annual return of 10%, but they have a 1% annual management fee, the net performance to you is going to be 9%. The 10% return less the management fee is going to be the net return you receive. Most of the time, you will not know the exact dollar amount you're paying for various mutual funds or ETFs. You'll simply have to look at the mutual fund or ETF prospectus to try to understand what the percentage management fee is, and then that is assessed based on the overall assets of the fund. Folks, this is the trickiest area of understanding how fees on investments work. There's a lot of literature written today about how mutual funds or ETFs with higher expense ratios are bad. And I'm going to tell you that not all mutual funds with high expense ratios are necessarily bad, but it begs the question, are you getting what you're paying for? If you own a mutual fund or an ETF with an excessively high expense ratio, you need to assess, are you actually getting compensated for that additional expense? Does the mutual fund or ETF deliver a better return at a lower risk than comparable other investments with lower expense ratios? If they do not, it's time to change funds. Understanding expense ratios on mutual funds and ETFs is probably the most complicated part of working with an advisor or even working directly with a brokerage firm on your investment strategies. This is something that takes a little bit of talent to know where to find it and to truly understand how it impacts your portfolio's net returns and the total cost that you're paying. One last point. We have a lot of financial advisors today that claim to be fee-based in the work that they do. And my question that I would encourage you to ask the advisor you're working with is, are you a fee-based advisor or are you a fee-only advisor? You see, there's a very distinct difference between these two types of advisors. And the difference is simply this. A fee-based advisor versus a fee-only advisor is allowed to collect advisory fees in addition to mutual fund trails. Now, if you're not familiar with mutual fund trails, what you need to know is that many mutual funds will include a given level of expenses in their annual expense reporting that is paid back to the financial advisor as a marketing fee. Many times you'll find these listed as 12B1 fees or mutual fund trails. Most of the time, they amount to 1/4%, and they are paid to the advisor on a quarterly basis, depending upon how much assets that advisor has in the fund. If you work with a financial advisor who says that they're a fee-based advisor, what that means is that they are potentially dipping their toe in the water two different ways. Number one, they're assessing you that regular monthly or quarterly advisory fee. That's the percentage-based fee we talked about a while ago, where they're charging you for the advice that they offer. But the sneaky thing about a fee-based advisor is they can also collect commissions under the table from the various products that they represent. The key question you need to ask yourself, ultimately, hopefully ask your advisor is, did you recommend that particular mutual fund because it was best for my situation or because it offered you that under the table mutual fund trail or commission? That's an important question to know the answer to. Why the fee-only advisor is different? Simply because the only type of compensation they can receive by law are the advisory fees that you agree to pay them for the advice that they offer. Folks, it's an important question. Are you fee-based or are you fee-only? Engrave Wealth is a fee-only advisor. We are not allowed to accept commissions of any kind in any way, shape, or form. Why do we talk about this and why do we bring this up? Quite simply because it is probably the number one most asked question we hear from potential clients. How do you get compensated? Folks, if you've not asked your advisor that question, it's an important question to answer. Most financial advisors have just enough gray space in their compensation that they make it confusing to know exactly where their motives lie and how they're being compensated. Why do we do things so differently here at Engrave Wealth? Because we've seen the difficulty it is to plan for retirement and build an investment portfolio that you can feel confident about. So we have created a commission-free fiduciary planning process that is designed to help you minimize the amount of taxes you pay in retirement, make sure you get the income that you need after retirement, and protect the portfolio from massive market downturns. Folks, if you've never engaged in a situation or conversation like this, we would like to invite you to answer some basic questions about retirement, like, does my portfolio carry too much risk? Or how much am I paying in commissions and fees? And do I need to be thinking about Roth conversions for future taxes and my tax liability from RMDs? All of these questions are answered for you in a personal retirement analysis that we call retirement optimization. Folks, to build a retirement optimization strategy, all we need to simply look at is a copy of last year's tax return and copies of your existing investment accounts so that we can be sure you are truly maximizing the tax savings opportunities, the income generation needed for retirement, and the market protection that you need in a portfolio. If you'd like to engage in that with us, we invite you to our website at engravewealth.com. You can click the button on the homepage that says Start Your Free Retirement Analysis. We'll collect some basic information so that we can reach out to you and schedule a convenient time to talk over a Zoom meeting or in person in our offices. Folks, I hope this is helpful. You need to be asking some basic questions about your financial advisor. And if these questions are not clear, we would invite you to take a look at doing things a different way. Thanks for your time today. We look forward to talking to you.